It's been a record-setting month on Wall Street. The Dow Jones Industrial Average up more than 1,000 points in November with 3 trading days to go in the month. Joining us now is Canaccord Genuity Chief Market Strategist Tony Dwyer. Tony, tell me why this could continue.
Dane, I'm typically
or if not, are you negative?
No, I'm typically
are you just going to rain on this Monday morning?
You know, since we've known each other, I tend to be on the optimistic side, and it's because most of the time the Fed is accommodative. And ultimately, that's what it comes down to.
We all want to know if you're always optimistic. What's the breakfast meal?
Well, so are you.
Yeah.
You're like Mr. Happiness.
Anthony, as you know, it all comes down to credit. Unless credit shuts down, you should never, ever, ever, ever sell stocks into weakness. Because when credit shuts down, you end up in a recession, you end up with weaker margins, you end up with lower earnings, the multiple comes in, and you go sustainably lower. So we haven't changed our opinion, frankly, other than, you know, tactical moves since 2009.
If you get back to 3% growth, the rates are going higher, so you're still going to be optimistic?
Yeah, the last time that rates actually went higher with the dollar, with corporate yields going up, was 2013, and it was an up 30% year. I think the mistake that we've made on the Street of Dreams here is that when you get increase in interest rates from such a low level, it helps the banks. And until it stops helping the banks, that's when you become negative with higher rates.
Well, what level is that on the 10-year? Because you have had a snapback in the yield on the 10-year. On Friday it closed, the last close was 2.359%. You take a look at it this morning.
You know, the Street is filled with guys and gals that try and figure out the rate. It's not the rate. It's whatever the rate is that on the short end, the Fed funds rate, that causes the 10-year to trade through it and invert the yield curve. So it could be 1.5% if the 10-year on the short end, if the 10-year is at 10.5%. It could be 4% if on the short end if the 10-year trades below 4. It's all about what is going to make a bank stop lending people money. So it's not the absolute level of rates, it's the spread between short-term interest rates and long-term interest rates.
If it's okay, I just want to embellish this a little bit. So what Tony is talking about is real interest rates. At the end of the day, real interest rates are the demand for money. Inflation-based interest rates are very different. So as an example, if the rates are going up because there's a demand for money out there in the private sector, stock market always does very well.
This is an extraordinary period of 7 years where people want to be negative. The real Fed funds rate, what the Fed is lending money at, hasn't changed since 2009, except for once so far, and probably once coming up in the next month. That's extraordinary accommodation. That hasn't even filtered its way into the global economy. So what if, Dagan, you actually get increased activity at the global level, not just the domestic level, which comes out this week in GDP and payrolls, but you get an increase in global activity, you get an increase in commodity prices, which we've generally seen an increase in commodity prices, and margins make a new high. You have an extraordinary story for expanding earnings. And
you didn't even mention any of the potential fiscal stimulus coming out of Trump. The Trump administration. I mean not just infrastructure spending, but just an overhaul of the tax code that would send more money flowing to businesses' bottom line.
Extraordinary. And that's what happens in the second half of an economic cycle. You get fiscal stimulus. The monetary stimulus has had time to work its way through the system. You get increased margins and increased earnings, and the multiples begin to expand. That's when you get the extraordinary move in the stock market, which is basically our calls. We have some of the best moves actually in front of us. And again, what stops that? What's the killer to that? And as you know, I've been negative in the past, and that comes when credit shuts down, when they're not going to give the people at this table and other people money to spend. We spend money. If you give me money, I'm going to spend it. Like, the mistake the Fed makes is they assume that when they lower interest rates and I refinance my debt, that I'm going to use that cost savings to pay down my debt. Well, no, I'm not. I'm going to spend more.
So, Tony, quickly, is it fair to attribute Trump's win to this rally over the past few weeks?
I think it's part of it because the market didn't tank. You know, our line that kind of jokingly was, we're going to make the markets great again. And that comes down, and that's because you've taken away that political nuclear warhead. Now, the thing that's so interesting that you have to remember, when you think back of all the election cycles, and I've been doing this a long time, I don't remember an election dictating economic activity. Now, this one may help, but it all comes down to how credit was acting going into the election, during the election, after the election. It's always about credit. Now, what the political environment can do is give you the opportunity to buy weakness.
Well, even some Hillary Clinton supporters woke up on early on Wednesday morning and said, she lost, but at least my taxes aren't going up. So that does dictate sentiment.
Taxes, hey, I've already spent the savings
what?
that I'm going to have on the taxes
again, who spends my money better, me or the government?
Me. I'll spend your money well, too.
But you know what I mean? That was a reaction by many of Clinton's supporters, so it does.
It totally was. Well, that's the hypocrisy of the whole thing. Is, you know, people that typically pay more taxes because they're in the upper echelon of wealth get the benefit of things like lower taxes, even though they argue against
Top 1% pays more than the bottom 90% in total tax dollars.
73.4% of the income tax is paid by the top 1%.
Right.
Yeah. Thank you, sir.
Thank you, guys.
No,
Great
thank
to see you
Tony.
guys.
Please come back soon, Tony Dwyer.
Will do.